Welcome back to the fourth lecture of Asset Pricing Theory 1. So here we would be discussing about single index model and the single index model, what is its definition, what is the purpose for having a model like this, the significance of single index model, its relationship between security returns and market returns, and the various assumptions, calculating beta and all those things are put into picture in the slides to come. So first let us understand what single index model is all about. So single index model, it's nothing but a financial model which is used to evaluate risk and return of individual securities in relation to market index. So one way or the other you can say that it is an extension or a combination of capital asset pricing model which we have already seen. Here it's called single index because we are considering only one parameter in order to measure, evaluate the risk, return and the market index in relation to the market index. So that's the reason why we have called it as single index. So single index is nothing but one factor, that means it controls the overall market return. So you are assuming that one factor, that is the beta factor, which is going to have an impact on the overall market, and that is going to explain any changes which is likely to happen in the asset returns. So what are the key concepts in single index model? It is assumed that the performance of any given stock can be expressed as a function of performance of market index. So which means any individual asset, let us assume that I am talking about the security of Infosys, I can talk about Infosys performance based upon the performance of market index, right? So it could be, instead of S&P, it could be Nifty or it could be Sensex or anything of that sort. So any index. So based on these index, the individual or given stock is likely to perform. That is the idea behind constructing single index model. And the relationship actually is going to bring down the complexity in real-time situations. Okay, so why the complexities are reduced? Because I am trying to compare one with one. So if you have more than one factor, it becomes a difficult thing, it becomes more complex. So that is why a single index model is considered to be less complex. What is the purpose for us to construct a single index model? The primary purpose for having a single index model is to bring about a specific asset, how return of specific asset is relating to the return of a broader market. So it means to say, I told you, I took the example of Infosys and I took the example of Nifty. So I am trying to say that how any change in Infosys is also reflected in a broader market. So specific asset, how it is correlating to a broader market is something which is being talked about when I am discussing about single index model. So this is useful under various conditions. One is for risk assessment. So while assessing the risk, what is happening is that we are trying to measure how sensitive a security is towards the total market movements. And this total market movement, in the earlier slides or earlier CAPM model, we have discussed it as beta. Okay. And the second important aspect of it is investors can assess the risk associated with the security. So first important aspect when we are talking about risk assessment is how sensitive an individual stock is in comparison to the overall market, and how an investor can use this information to relate it with the return he would be getting by means of investing in a particular stock. So that's the first purpose. The second purpose for constructing a single index model is portfolio management. So portfolio management, as the name suggests, portfolio, it is diversified stocks. So I can have diversified portfolio by identifying securities which behave differently in comparison to the market. So which means I have say 3 or 4 stocks A, B, C, D, and I have Nifty. So when Nifty increases, I find A is increasing, B is decreasing, C is decreasing, and D is increasing. So if this is the pattern which individual stocks follow, then while constructing a portfolio, I can diversify it by including stocks which are directly proportional with the overall market, like this and like this, and which are inversely proportional to the overall market, like B and C. So that's the important aspect of portfolio management. Next is with regard to performance evaluation. So performance evaluation, I am trying to measure the individual stock performance against a benchmark index. So let us assume that the benchmark index is 100. I keep the benchmark as 100, and in response to 100, how the individual stocks are being evaluated. So let us assume that A is evaluated at 80, B is evaluated at 70, C at 60, D at 90. So if I am going to put it like this, then overall my purpose is solved, where these are moving in different directions in response to the overall market, but at the same time I have diversified my portfolio, wherein the chances of losses are reduced. What is the importance of single index model? First importance is it's used for streamlining analysis. So what do you mean by streamlining analysis? The first thing is that I'm just trying to compare it with one particular activity. That is, my return is compared only with the market index. So the idea behind looking at how the returns would be is simplified. Okay, so I've streamlined it to market index. And what does SIM actually do? It actually reduces the complexities which is involved in multiple risk factors. So multiple risk factors, as I told you earlier, that there are many risk factors which can have an influence, but I presume that all these risk factors are reflected in the market index. Okay, so instead of taking these factors separately, it is better for me to use only this, which has already incorporated these multiple factors. So it becomes easier for investors to take a decision. That's the significance of using single index model. And baseline for advanced model, it serves as a foundational concept in finance, as CAPM had done, and I can develop complex models considering multiple factors influencing asset returns. So the expansion is possible. So it's always better to have something simple, and I can make these things complex by including more and more factors into it. As I told you in the previous lecture, that CAPM also had certain criticisms which showed that it was not correct by Fama and French. So if such situation occurs, then I have the freedom to increase the number of factors included, so that I can have advanced models into the picture. So I told you the investment behavior and all those things, behavioral finance, all those things could be incorporated into the whole scenario. Now, how is it measured? So it is measured almost in a similar manner as we had done it for capital asset pricing model. So this is a linear relationship, same as linear relationship, and this relationship is between the return of individual security and return of a market index. So, there are only two major components which is available in this particular linear equation. Okay. So, I have the expected return. So, the expected return is dependent on excess return which my individual security would be giving, that is alpha. Alpha is the intercept which represents the excess return independent of market. So, which means this has nothing to do with market. So, market may go up, market may come down, we are not concerned about it, but there are certain factors which can move in such direction, plus the beta factor, it is the sensitivity of return of the market stocks. So, it is the market return, beta of market return plus epsilon. So, epsilon is nothing but some unpredictable things which is likely to happen in the market is considered to be the error term. Okay. So, the difference between a CAPM model and this particular model is that here we are not considering anything called a risk-free rate of return. There is nothing called a risk-free rate of return. It says that return of my portfolio is directly dependent on the overall market and the risk associated with the overall market. Okay. So, whatever excess I would be getting by means of my performance is considered to be independent of itself, which is reflected in alpha. Okay. And epsilon is for those factors which is not actually measurable. It can happen sometimes, it could be because of an earthquake which has happened, it could be because of elections being conducted. So, similar such idiosyncratic risk is being included in this particular aspect, and this is normally measured in the error terms. So, if you have a time series data based on the error terms, you can incorporate the epsilon part over there. What is the theoretical foundation of SIM? It is based on the idea that there is only a single factor that is nothing but the market index, which is actually having a impact on the behavior of the return which your stock actually is going to give you. Okay. And this is an explanation of the earlier slide which we have seen. The return whatever is there is dependent on the independent factor. Alpha is nothing but the securities intercept or the excess return. So, the graph which we had in the earlier thing where the efficient front tire which we had drawn in efficient market hypothesis. So, this is the intercept part. So, the intercept part is nothing but the alpha. So, this is the return which you would be getting for a stock, average of the stock which you have invested. Okay. So, this is risk, this is the return. So, this is the average risk return whatever you have got. This is the risk-free rate of return which is not applicable for us. So, the slope when it is drawn, so it is nothing but the independent factor, the market factors which can have an influence on my stock, plus any untoward incident which can have an impact on the prices of my stock is referred in the error term. What are the assumptions of single index model? The various assumptions which you have taken in single index model is, first is market efficiency. As we had in capital asset pricing model, the market efficiency says that all available information is reflected in the prices of stocks. Okay. So, any individual shares whatever I am trying to purchase, so all these informations are going to have an influence on the price of the stock. The second important assumption is that the prices could be determined based on a linear relationship. So, the linear relationship is between the securities return and the market's return. So it's a one-to-one relationship which can be done. The third is normally distributed return. So if suppose I am going to use security return and market return as the two parameters on which it has to be measured, then the return whatever I am going to get is normally distributed. So which means to say that when the security prices are moving up in a similar pattern, the market return is also going to move up. It can be either directly proportional or inversely proportional. And the third important aspect is you have a constant beta for a particular period of time. So for the period, the risk factor which is associated with the price movements is going to remain the same. How is beta calculated over here? Beta is calculated and not taken up when we were discussing the CAPM model. I just talked about beta as the combined effect of various factors which can have an influence on the price of the stock which you are purchased. Okay, so beta is actually calculated by means of covariance of the individual stock which you have in response to the market stock. So it is the covariance of the return on expected return and the market return. So I put it as slash, it is actually comma. So that's what you are trying to find out. That's how you are trying to find out beta. Okay. So it's explained over here. It is the variance of the market return into the covariance between the market return and individual stock. Okay. How do I interpret beta? So if suppose beta is equal to 1, then it means to say that the security moves along with the market. So whatever the stock I am holding, that is going to go along with the market. If the market increases, my stock will also increase. If suppose the beta is greater than 1, it means to say that the security is more volatile. So it means to say that when index increases, my stock will increase more than the time market has increased. If the market has increased 1 time, my stock may increase 3 times, right? So that is volatility. If the market decreases, then by 1 point, then my stock will decrease by 3 points. So if suppose there is a high variation of this manner, then it is considered to be highly volatile. The third, when it is less than 1. So when beta is less than 1, it means to say that stock is less volatile than the market. So it means to say it becomes opposite. When the market is moving up by 3 times, my individual stock is going to move up by 1 point. Okay, and when the overall market is coming down by 3 points, my individual stock is going to come down by 1 point. So that is less volatility in comparison to the stock based upon beta. What are the different advantages of single index model? First is its simplicity. Why it is simple? Because you do not have more variables involved in it. It is a straightforward way of analyzing risk and return, because I just have one factor which I have to consider, that is the market return, and based on the market return compare my stock return. So it is very simple and straightforward. Second is the reduced complexity. The reduced complexity because the number of parameters which I am using for assessing the performance is very low. As I told you, I am going to use only market return and security return. And ease of use, anyone can use it because the number of variables are less. So it becomes easier for everyone to understand. You do not need any complex software for calculating the whole thing. So it actually facilitates portfolio management, and you can also measure the performance of the stock based on the performance of the overall market, that is single market index, based on its index. So that is the ease of use and advantage. And what is the limitations of SIM, it is oversimplification. So what happens is sometimes when the number of factors becomes very less, even that can be very complex. Since I'm just comparing market return with the individual stock return, I'm just having two factors over here. Sometimes it may not capture all the other relevant factors which is having an impact on security return. So that's another one of the limitation of SIM. Second is the assumption of constant beta. So here I told you we are not giving much importance to beta because we assume that the market condition is similar to the condition which is going to affect the stock. So in reality it may not be. So in reality the beta may change due to market conditions. So conditions can have an impact on market on the beta calculation, so which is not actually reflected in the single index model. And third is ignoring other risk factors. Some of the other risk factors which we have ignored is the liquidity risk, the credit risk which is associated with it, and many more other things, forex and other things, sovereign risk and other things are there which we have not considered while using this single index model. What are the areas where single index model can be used? First is in portfolio management. As the name suggests, portfolio management, I can construct diversified portfolio by assessing the individual securities in relation to the overall market. So it becomes simple, as I told you in the earlier slide. If suppose I have A, B, C, D and market is moving in different direction, how I can include all these stocks so that the portfolio could be managed in a better manner. The second is evaluation, performance evaluation. So normally we find that this particular model is more prevalent in the mutual fund sector, and the performance of comparing it with the returns to market index becomes easier, and you can calculate the net asset value and other things in simple conditions. So these are some of the important aspects in terms of performance evaluation. Risk assessment, it helps in determining the risk adjusted performance of assets. So if suppose I have 100 rupees in my hand and I want to invest in A, B, C, D, I can divide it into X1, X2, X3, X4 accordingly. So I can have different proportions, that is 20% of A, 30% of B, 20% of C, 30% of A. Sometimes if this doesn't work, if suppose there is more changes happening in the market, then I can reduce this to 10%. My invested amount is not likely to change. It is only the percentage of investment which is likely to change. So I'm just adjusting the risk based upon the performance. So I'm reducing this to 10%, I'm increasing this to 40%, and others remain same as 20 and 30. So like this I can bring about change in the overall thing. And what is the role of single index model in modern finance? I can integrate the single index model with a multi-factor model, so it becomes easier. So multi-factor model like the one which Pharma French had created, so I can integrate it, and things could be done in a better manner. Then we can have more complex model which will explain the market in a better manner. Okay, so that's one of the important advantages of it. And its continued relevance, it is always believing that there is a relationship between risk and return, and whatever is having an impact on these two could be incorporated at any point of time to make it more complex. So that is the simplicity in itself is going to help the market overall. So in a nutshell, the single index model is considered to be a fundamental approach to the asset pricing, wherein I'm trying to incorporate individual securities to market index. and where we can think about expanding this particular thing is I can extend the single index model into a complex model where more and more variables could be incorporated in it, and by means of incorporating it, I can have a better understanding model, which could be a combination of capital asset pricing model plus the single asset pricing model plus the pharma French model. So I can have a complex model as big as this, or it could be a combination of any of the available models which is there in the market. Thank you.